Welcome to the Valuation Desk by Highland Global, where SBA business valuations speak bank. I'm excited to share a topic that's critical for SBA 7A lending, especially in business acquisitions, the difference between global cash flow and free cash flow. We'll explore what they are, how they're used, and why global cash flow should never inflate a business's valuation. Getting this right protects buyers, sellers, and lenders like you. What is global cash flow? In SBA 7A underwriting, lenders look beyond the business being financed. They assess the buyer, often the guarantor, and any other businesses they own. That's global cash flow, combining the business's cash flow, the buyer's personal income, like wages or investments, and cash from affiliate businesses. Lenders then compare this total to all debt payments, including the SBA loan, personal loans, and affiliate debts. This gives the global debt service coverage ratio, or global DSCR. Many lenders require a DSCR of 1.15 times, meaning 15% more cash than needed to cover debts, ensuring a safety net if income dips. Global cash flow is all about repayment ability and risk mitigation. What is free cash flow? Now contrast that with free cash flow used in business valuations. This is entirely different. Appraisers focus only on the standalone earning power of the business itself, not who's buying it or their personal wealth. The question is, what cash flow would a hypothetical buyer expect if they bought this business tomorrow? Free cash flow is what's left after operating expenses, taxes, capital expenditures, and working capital needs. Appraisers prefer the capitalization of earnings method for SBA 7A valuations, using free cash flow to estimate sustainable value, though discounted cash flow models are also used. This ensures the valuation reflects the business's true worth in the open market. Why does this difference matter? There's a dangerous misunderstanding in small business deals. Some lenders argue that a buyer's strong personal income or other business income justifies paying more than the valuation. They'll say, the borrower's global cash flow covers the loan payments, so let's raise the purchase price. That might help get a loan approved, but it doesn't make the business worth more. Let's dive into why. There are 3 key reasons global cash flow cannot boost a business's valuation. First, valuation reflects business-only risk. SBA rules and appraisers focus on the business's standalone cash flow, not the buyer's finances. That's what drives the fair market value. Second, global cash flow is buyer-specific. A wealthy buyer's extra income doesn't apply to another buyer, and the fair market value standard required by the SBA requires valuations based on a hypothetical, financial buyer, not a specific buyer. Third, loan approval doesn't equal business value. Strong global cash flow might secure funding, but the purchase price must match the business's free cash flow-based value. For example, a business with $200,000 free but $600,000 global cash flow, including $400,000 from a guarantor's income, supports loan approval but not a valuation above that based on the $200,000 free cash flow of the business. Let's recap. Global cash flow helps lenders assess whether the borrower, including their personal and business finances, can repay an SBA 7A loan. Free cash flow determines the business's true worth based on its standalone earnings, using the capitalization of earnings method for stability. Strong global cash flow doesn't justify a higher purchase price. It's about loan repayment, not business value. As lenders, brokers, buyers, or advisors, keep these lines clear. Use global cash flow to evaluate repayment risk and free cash flow to set value. Ask appraisers to confirm their valuation uses free cash flow to ensure SBA 7A collateral is realistic and the deal is fair. Thanks for joining us for this episode of the Valuation Desk. Behind every financial model and final value is a professional who knows how to interpret the story behind the numbers. At Highland Global, our depth of experience ensures that your appraisal isn't just technically sound, it's contextually accurate, SBA compliant, and thoughtfully reasoned. We've prepared thousands of business valuations and machinery appraisals, and we understand the details that make or break a deal. Because in lending, it's not just about the math, it's about the judgment behind it. For more information on valuation-related topics, be sure to visit our website highlandglobal.com. Lenders know experience matters most.